Welcome to this explainer on the hidden AI revolution. I am so incredibly thrilled to dive into this one with you today. Look, we all know the broader market is hyper-focused on those trillion-dollar tech titans right now. But while everyone is crowding into the mega caps, there's an entirely different tier of innovation happening right beneath the surface. Today, we're cutting through the noise and dissecting the data on 3 specific, accessible AI companies, all trading under $20 a share, that are uniquely positioned for explosive growth by 2026. Here is our roadmap. We'll quickly define the accessible AI market, dive into SoundHound's voice tech, BigBear's defense AI, and Pagaya's fintech revolution before wrapping up with our final takeaways. Let's get right to it. Starting with Section 1, the accessible AI market, and how we actually go about finding asymmetric risk-reward. So why are we hunting in this specific tier? Well, the core problem is pretty obvious. Mega caps are currently priced for absolute perfection. It's a crowded trade. But these smaller innovators under $20, they offer a really compelling asymmetric risk-reward profile. You aren't paying a massive premium just to get in the door. Instead, you're looking at limited downside relative to multi-bagger potential. If, and it's a big if, they can successfully capture their specific niche. Now, I want to be super clear. We're not just throwing darts at unproven penny stocks here. We are strictly analyzing companies that meet some seriously rigorous criteria. Every single company we're exploring today has real revenue traction right now. They're targeting massive, real-world addressable markets, they've secured strong partnerships, and most importantly, they have a clear mathematical path to scalability alongside valuations that actually make sense. That brings us to Section 2, focusing on the everyday consumer experience, SoundHound AI and ubiquitous voice AI. Trading right around that $7 to $8 mark, SoundHound, ticker SoUn, is doing some fascinating things. They are moving way past basic voice recognition and getting into deep, context-aware interactions. We aren't talking about asking your smart speaker to set a 10-minute timer. SoundHound is building natural language understanding that can process incredibly complex, layered requests in super noisy environments. Think a bustling restaurant drive-thru or a moving car on the highway. And they're already flawlessly integrating this with major automotive and hospitality brands. What really gives them a competitive moat is this concept of agentic AI. Instead of just fetching a weather report or giving you a simple answer, SoundHound's latest enterprise systems, like Sales Assist, actually take proactive actions for you. They complete multi-step tasks totally autonomously. That is a real game changer for the sheer utility and the addressable market of voice software. And that structural advantage is paying off. It led to record Q1 2026 revenue of $44.2 million. They beat estimates with a massive 52% year-over-year growth rate. So this isn't just some abstract technology play. It is translating directly into explosive top-line financial expansion. Projecting this out to 2027, the compounding growth trajectory here is incredibly steep. After roughly doubling their revenue to $169 million in 2025, their 2026 guidance midpoint sits around $242 million. And looking even further ahead to 2027, management is targeting an outlook of $350 to $400 million. That is rapid structural growth, any way you slice it. But let's keep it real for a second. You absolutely have to balance that high implied analyst upside against the actual operational risks. Yes, their gross margins are improving as they scale, but they're directly competing against heavy hitters like Google and Amazon. Plus, they're currently unprofitable and investing heavily in R&D, which means potential dilution down the line for investors. You're paying a forward price-to-sales multiple of 13 to 18 times here, so to justify that investment, you have to be a firm believer that these conversational interfaces will become the global standard. Transitioning from consumer tech to the high-stakes world of national security, we arrive at Section 3, BigBear.ai and mission-critical defense AI. At just $4 to $5 a share, BigBear, ticker BBAI, leverages AI for threat detection and supply chain optimization. And honestly, in our current era of geopolitical tension, this is absolutely vital. This is a highly specialized use case. They aren't trying to build the next fun consumer chatbot. They are actively providing mission-ready decision intelligence. They help the U.S. and its allies process vast amounts of data for faster, better command decisions on the battlefield and in classified operations. Now, this number is huge. BigBear's Q1 2026 backlog sits at a massive $281.9 million. This was heavily boosted by a $53 million sole source prime classified award. And that's exactly what sets defense contractors apart. When you see a backlog this substantial, growing 14% sequentially, it provides incredibly clear visibility because the revenue is contracted, not speculative. Plus, a sole source award signals deep trust and exceptionally high barriers to entry for any potential competitors. Now, technically, their revenue was flat, sitting at $34.4 million due to some program timing issues. But look past that for a second. Their dramatic margin expansion, jumping 12 full percentage points to hit 34%, shows a highly disciplined operation. Furthermore, they acquired a company called Ask Sage, which adds tailored, defense-grade generative AI to their toolkit. Analysts actually estimate that could add another $25 million in annual recurring revenue. Looking at the data neutrally, investors have to weigh the high barriers to entry of these defense contracts against the very real risks of government funding delays. The strategic advantage is obvious, a massive, highly visible pipeline relative to a pretty low market cap. However, the elephant in the room is their total dependence on government bureaucracy. If policy shifts or funding gets tied up in Congress, their revenue gets delayed. So it's a speculative but strategically vital play in the global AI arms race. Finally, let's explore the back-office engine of the economy in Section 4, Pagaya Technologies and the fintech AI revolution. Trading right around $14 to $15, Pagaya, ticker PGY, applies AI to real-world finance at a massive institutional scale. They're serving non-prime borrowers who are way too often overlooked by traditional banking models. While AI gets a ton of hype in the media for generating text and images, Pagaya is doing the heavy lifting behind the scenes. They use intricate machine learning networks to analyze vast datasets, which allows banks and lenders to approve and price asset-backed securities, auto loans, and personal loans with far greater accuracy and significantly lower risk. The sheer scale we are talking about here is just fascinating. This small-cap stock is projecting low-end guidance of $1.4 billion for 2026, stretching all the way up to $1.575 billion on the high end. They are pushing immense volume through their AI network, and the beautiful part is, the more volume they process, the more efficient and lucrative their model actually becomes. And here's the kicker. Because they have successfully strung together profitable quarters, they trade at a really attractive 13 to 15 trailing price-to-earnings ratio, meaning they are actually making money relative to their stock price right now. When you look at high-growth tech stocks, finding a reasonable valuation is incredibly difficult, mostly because they are valued purely on future sales. But generating true bottom-line net income in the range of $110 to $160 million makes Pagaya a rare fundamental standout in the small-cap AI space. Now, while Pagaya could absolutely be a steady compounder, their success is heavily tied to macroeconomic credit cycles and interest rate fluctuations. There are strong catalysts for sure, like an expanding partnership with Experian and analyst targets implying up to 130% upside, but you must weigh those against the broader industry risks. If we enter a severe credit cycle or interest rates start behaving unpredictably, their loan volume and securitization demand could take a major hit. You definitely have to be comfortable with fintech volatility if you're going to hold this one. Okay, let's synthesize these 3 unique opportunities to round out our explainer in Section 5, diversification and final takeaways. By spreading exposure across consumer, government, and financial AI verticals, investors can capture some seriously compelling sub-$20 growth while mitigating sector-specific risks. Whether it's SoundHound's push for voice ubiquity, BigBear's defense criticality, or Pagaya's practical fintech applications, all 3 offer impressive growth profiles with real-world traction. But please, remember the golden rule of risk management here. Volatility is absolutely guaranteed in this space. Position sizing must be appropriate, and your timeline needs to be strictly long-term to let these profitability theses actually compound. As we wrap up this explainer on the AI market's hidden gems, take a moment to consider your own risk tolerance. Which of these 3 distinct pillars best fits your long-term thesis? Are you betting on the everyday, widespread adoption of conversational AI, the unavoidable necessity of national defense intelligence, or the massive institutional scale of AI-driven lending? Take some time to think about how these uniquely structure the future of technology, and as always, keep exploring the data.